Revised fourth quarter GDP figures show an unexpected slowdown for the U.S. economy, but it was a slight one, down 0.1%. At the same time, inflation edged higher. Karina Mitchell reports from New York.
So it was a good report, but overall we saw that the U.S. economy advanced at a slower pace than we initially estimated at the end of last year. So the Commerce Department reporting in its first revision of fourth quarter GDP that the economy accelerated at an annualized pace of 3.2% compared to 3.3%. Analysts had expected that number to be unchanged. It did come in lower partly because of lower inventories. But I want to help put that into context because before we got that first read of GDP for the fourth quarter, analysts had expected it to come in at around 2%. So we've got a much more solid number, 3.2%. This is a very strong report, and we're doing much better than several other advanced economies, albeit we're off that blistering 4.9% growth that we saw in the third quarter of last year. And that momentum is carrying forward into this year as well. The forecast is that we'll see GDP come in above 3% for the first quarter of this year. Overall, the IMF, the International Monetary Fund, says that U.S. growth is estimated to come in for the entire year 2024 at about 2.1%, which seems more modest, but that is more than double than some of the estimates for other advanced countries, including the UK, Germany, and Japan. And overall, this is the sixth consecutive quarter that we've seen GDP come in at above 2%. So definitely a very solid report there. And it all comes in a high rate environment, thanks to our central bank, which has been trying to cut rates thanks to inflation. Now, the other thing that we saw in this report is that inflation did edge higher. It came in at 3%, accelerating above 2.8%. The estimate was for it to actually go the other way, to come down to 2.7%. But that's really because of the strong labor market that continues to exist in the U.S. People are comfortable in their jobs, and so they're comfortable spending, and that's helping drive GDP growth. Economic spending is the biggest engine of economic growth. The second biggest driver is business investment. That's where we saw a little bit of a reversal in this report. It was expected that business investment grew at a rate of 2.1% at the end of the fourth quarter. That has actually been revised down to growth of just 0.9%. So that is a headwind. Other headwinds include the U.S. Trade deficit, which just grew. We have also a very strong U.S. dollar at the moment. All of these things will play into GDP, and we will get more consumer data when PCE information is released in just a few hours from now. Karina Mitchell, CGTN, New York.
So how did the latest numbers affect the markets? John Terrett has details from the New York Stock Exchange.
The third down day on Wall Street on Wednesday for the Dow Jones, lacking direction at the moment, waiting really for things to happen, like maybe an indication of when, if ever, U.S. interest rates might actually be cut. Anyway, on the Wednesday session, the Dow was basically flat, down 23 points to stand at 38,900. Third day down then, retreating from the highs of last week and the week before, but still positive for February. The Nasdaq down 0.5%, 87 points. The S&P 500 down 1/16 of 1%, 8 points at 5069, with real estate leading the way out of the 11 sectors on the S&P 500 on Wednesday. But again, positive for the month of February. Just 1 day's trading left, of course, there. Bitcoin having a very good day on Wednesday. Around 64,000 now. That's a remarkable comeback. And on Thursday, earnings come from Best Buy, which is where Americans get their electronic goods from these days. Birkenstock, the German shoe company that came to market in 2023 here at the New York Stock Exchange. And the Norwegian Cruise Line, another indicator, I think, of inflation and consumer sentiment. Because if people are spending on cruises, then that's all you need to know. They've got money and they're prepared to spend it. And potentially that's bad news for the central bank, the Federal Reserve, to try to calm things down, to bring down inflation. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more insight into the U.S. economy, let's bring in Thomas Hayes. He's founder, chairman, and managing member of equity manager, Great Hill Capital. Thomas, what do you make of these numbers?
Well, Asieh, I think it was kind of a wash. What we saw was core PCE was up just a hair, but it's still trending towards that 2% inflation target of the Fed. And the GDP, although it was revised down 0.1%, that was largely due to the private inventory investment being down and offset by government spending and consumer spending. And as we know in the U.S., never underestimate the consumer. When they have a job, they spend.
And if they have a job and they want to spend, what are they spending their money on?
Well, it seems like just about everything, Asieh. I mean, we're just finishing up the earnings season with 75% of the S&P companies reporting. We beat across the board 3.2% earnings growth versus 1% earnings growth estimated. If you look at Q1 GDP now from the Atlanta Fed, they're estimating GDP growth in Q1 is going to be around 3% as well. So we continue to fire on all cylinders. We saw Chris Waller today talking about the possibility of 3 cuts towards the back half of the year, but it's not guaranteed. They want to see those inflation numbers come down, and they want to see that tomorrow with core PCE.
Sorry, I don't know if you already answered my question, but what are consumers spending their money on? What are they buying?
Well, across the board, certainly luxury items have been very, very strong. Travel and experiences, we're going to see the cruise line report earnings, as John Terrett was saying earlier. You name it, they've been spending. Apparel, you've seen the Abercrombie and Fitches of the world. So they've got their travel, they've got their goods, and I think we're seeing also a continued move in services, which is why services have remained a little bit sticky and been a little stubborn as it relates to the inflation numbers, Asieh.
And if you are an average American consumer and you are working and you do have an income, are there things you're holding back on in terms of spending?
Well, I think the interest rate sensitive larger items have been a little bit slower, but they're starting to come back. One of the companies we're invested in is Generac. They do home standby generators, and those are often financed because they're a large ticket item. Those have been slower, but they're starting now to reaccelerate with rates appearing that they're going to be coming down towards the end of the year. That has people optimistic. New car purchases have been good, but they could get a lot better relative to overall demand. If you look at new licensed drivers and the average car age on the road, both of those numbers are going up dramatically. So we should see a lot of new car sales. The lowered rates towards the back half of the year are really going to accelerate that pent-up demand. So they've been holding off on some of those bigger ticket interest rate sensitive items, and of course new houses with limited supply.
You know, when was the last time you were at the grocery store? Because I can tell you, every time I go to the grocery store, I am astounded by how much more I'm paying for groceries. I was going to ask you what the big concern for Americans are when it comes to economic issues, and I bet you one of it is inflation and the price of food.
Yeah, there's no question in the last few years the price of food has gone up materially. It's slowing. The pace at which it's going up is certainly slowing, but we saw from Walmart earnings, of course, consumers are dialed back a hair on discretionary items, you know, kind of the non-grocery part of their store, and focused more on the food because a lot of their discretionary income is currently being eaten up by the higher food prices that you're referring to, particularly the top end of the economic strata that has to be focused on the essentials for the time being.
How much of a concern, Thomas, is recession still this year?
Very low. Very low with this level of employment, with this level of growth. Inflation is coming down, productivity is gaining, and what we're going to see is that we're actually going to be able to sustain higher rates of growth than expected while inflation falls due to the abnormally high productivity gains that we're starting to see. Some of it's a result of efficiency, some of it's a result of AI and different efficiency measures that companies have put in place. And a lot of it has to do with, Asieh, is CEOs were preparing all of last year for a recession that never came. So they got their efficiency in order, they cut costs, and now we still have a booming economy, and that's all going to the bottom line. So we're in a pretty good place. The only thing that could potentially impair that outlook would be if the Fed waits too long, because there is a lagged effect of such an aggressive tightening cycle, and it's, you know, historically it's between 6 and 24 months. So we don't know when that's going to kick in, and they need to keep a hawk's eye on that so that when they do see that little sign of slowing, and I think we're seeing it in the inflation numbers, that they the sooner they do a cut, the less cuts they'll actually have to do.
All right, we'll leave it there. Thomas Hayes, thank you very much.
Thank you, Asieh.